mortgage and real estate markets are taking us for a wild ride, and we can just strap in and hold on tight. All right, welcome everybody to SRT Live. I am your host, Sean, with the Sean Richard Mortgage team here at Guaranteed Rate. Thank you so much for joining me today. I appreciate your patience as I was running a little bit behind, but it is a jam-packed day today. Lots of housing data going to be coming out this week. It's really going to give us a pulse of the housing market going forward. And so let's jump right in and let's talk about what we saw last week with another action-packed week then as well. Last week, the main components of our focus was on inflation. And we got two inflation reports last week. We got PPI, which is Producer Price Index, and that's going to be inflation at the wholesale level. Now, this tells us kind of input costs, right? At the end of the day, we've got our consumers that are paying, for end user goods and services, but Producer Price Index really tells us input costs, which is a forecasting measure because it's going to give us a glimpse into where consumer prices could end up down the road. And so we got that inflationary report and it came in pretty hot. Month over month, we saw an increase of 0.4%. This was 0.2% above expectations, but it was also 0.6% over the previous reading. So inflation has heated back up at the wholesale level. Now, these numbers factored into the 12-month rolling average gave us a year-over-year number of 8.5% inflation. This was up from expectations of 8.4. So again, coming in hotter than expected. And although it was down from the previous reading of 8.7%, still coming in hotter than expected is bad news on the inflation front. Now, we also got Consumer Price Index. So Producer Price Index we got last Wednesday, I believe, and Consumer Price Index we got on Thursday. Consumer Price Index also coming in hotter than expected. Month over month numbers, we got 0.4% increase, and this was up from 0.1 or 0.1% from the prior month's reading. And this also, like Producer Price Index, came in 0.2% hotter than expectations. So we're seeing input numbers rising. We're also seeing output numbers rising as well. And this is keeping consumers on their toes. And this is also pushing the aggressive stance that the Fed has been taking against inflation. Now, year over year came in a little bit hotter than expected as well. 8.2% year over year inflation versus 8.1% expected. Previous reading, 8.4. So again, we got a decrease overall in inflationary numbers, but we came in hotter than expected. We need to start seeing these numbers come back down a little bit faster. Now, as I mentioned, this is a 12-month rolling average, and the July, August, September readings from 2021 were quite low. They were all 0.5% or lower. September in particular was 0.3% month over month reading from last year. So we lost a fairly low number and replaced it with a slightly higher number, and that pushed our average up. The good news is we may have seen inflation peak, at least from an inflationary report standpoint. The reason for that is because as we head into the fourth quarter, we're in the fourth quarter, but as we continue through the fourth quarter, the month over month readings from fourth quarter of 2021 last year that will be dropping off as we roll month over month are quite high. October of 2021, as an example, was 0.9%. So when that October reading comes out in November, if that number is quite low, we're going to start to see a healthy decline in inflation on our reports. So something to keep an eye on as we head further into the fourth quarter. Now, we also got the University of Michigan Consumer Sentiment Report, and this is a survey of consumers on the economic outlook. Surprisingly, this ticked up. We had been seeing a trend of declining sentiment for the past several months. The expectation, or I guess the previous reading, was 58.6, and that ticked up to 59.8. So consumers seemingly having a little bit more optimism about the economic outlook where we're headed. However, I would argue that being in the 50s, we're probably still looking at just very moderate expectations. Nobody's super excited about the economic outlook, but at the same time, not completely dismal on that forefront as well. All right, so that was last week. This week, we've already had a little bit of information giving us an insight into the economy and the housing market. We got the NAHB, which is the National Association of Home Builders Housing Market Index, and the um, this measures builders' sentiment on the housing market going forward and their business. So this scale is really, 0 to 100. Anything above 50 is optimism and expected growth. Anything under 50 is maybe a little bit of pessimism and expected shrinkage in the building sector, in the new home construction sector. And so the previous reading was 46. So we fell under that 50 mark, showing a little bit less optimism about where the new construction is headed. This month came in at 38. Home builders not liking the direction of where the housing market is going right now from a new construction standpoint. We've already seen home builders start to slow their construction, and this is only going to further exacerbate the supply issues that we have in our industry. So, for those of you out there that think that we're going to see a major housing market crash, or if you're a real estate agent and you want to have really quality conversations with your clients about the direction that the housing market is headed, one of the things that you can point to is the lack of inventory and how that's going to continue to be in shortage range for the foreseeable future. Builders are slowing down, sellers are not quite selling as often, and we're going to continue to see supply issues on the housing front. Though demand is shrinking, if supply is not increasing, we're not seeing a significant change in that supply demand dynamic, which is going to bode well for home prices. We may see a small dip or a plateau from where we've been, but we were never going to continue the double digit appreciation rates that we've seen over the past several years. So we're going to see a little bit of a drop off in house home prices, most likely, but it's more of a leveling off and not a crash like we may see in some of the bigger metropolitan areas like an LA, New York, things like that. Then we also got the New York Empire Manufacturing Index. And this is a survey of manufacturing firms in the New York region. And this is measuring expectations of business conditions, whether they're expected to improve, decline. And so this came in at a negative 9.1. And this was almost double the expectations of a negative 5 on this survey. So, what does that tell us? That tells us that manufacturing is slowing down and the outlook going forward for manufacturing is not ideal. Now, this shouldn't be anything new and this shouldn't be breaking news to anyone. We've seen 2 consecutive quarterly prints of negative GDP, and there's a very good possibility that we're going to see a third consecutive negative GDP print for third quarter. So the fact that the economy is slowing down and it looks like we're heading into a recession is something that I've been talking about really for months now, if you've been following me. And so slowing down the manufacturing sector doesn't necessarily come as breaking news, but it's just one more data point that tells us that we are heading in that direction if, in fact, we're not already in a recession. So we've already gotten that this week, but the rest of this week is chock full of housing data. So starting tomorrow, we get housing starts and building permits. Housing starts gives us housing construction for single family residences, and it helps us measure, the status or the health of the new construction market as well. Building permits is measuring permits issued on new construction projects. So that's not specifically housing, it's new construction projects as a whole, but it really gives us an idea of the state of construction in general across the country. And that includes our housing market. Thursday, as always, we get our jobless claims. This is unemployment claims. And then we also get existing home sales. Now, this is going to be a critical one because existing home sales makes up about 90% of our real estate industry. So looking at the pace of sales and quantity for the existing home sales on Thursday is going to give us a really good insight into where we're headed in this fourth quarter. Um, we're expecting a drop off. Inventory is slim, and we've seen demand dwindle due to rising prices, rising interest rates. So I would expect a drop off in this number, but let's see where that comes in and how big of a drop off that we have. And then Friday, a little bit of a quiet day. So the technical details will really drive where the markets go on Friday. All right. So, what are we looking for? What are we focused on as we move forward the rest of this week and the coming weeks? All right. Number one is the state of the housing market. Where's our new construction pace? Are we going to continue to see construction home sales slow down, which is going to continue to stunt our inventory in the market? And remember, I've said this just a moment ago, but although demand has dwindled, if supply continues to stay low or dwindles further, then we're going to have better pricing stability with housing. And I cannot stress that enough. If you're a home buyer, or if you're a homeowner and you are worried about the price of homes, or if you're a homeowner worried about the price of your home, maybe you're thinking about selling when when the timing is right, you can feel relatively confident that the lack of supply, even though demand has dwindled, the lack of supply will help keep home prices relatively stable. We may see a plateau, we may see a slight dip, but my belief is that here in the Dallas-Fort Worth Metroplex, we will not see a major housing crash. And if I'm wrong, so be it, but the data tells us otherwise. So unless something significant is going to change, have confidence in home prices. And then pace of home sales. Again, we're going to watch that. That's coming up on Thursday. See where existing home sales comes in at. The other thing that we are heavily watching, and we've been watching for quite a while, is of course inflation. Has it peaked? We're going to see as we get our next CPI, Consumer Price Index report, in the month of November, reporting for the month of October. And we're expecting and hoping that we're going to see that dip. What will inflation look like in fourth quarter? So we're going to watch that CPI data and see where how big of a decrease. Now, the Fed has come out and said that they're going to continue to be aggressive. Unfortunately, the most recent consumer price index data showing inflation rising is all but guaranteed that the Fed is going to stick to their aggressive plan. Originally, the thought was we were going to see a 50 basis point increase in the Fed funds rate in November. Now it looks like we very well could see 75 basis points or 0.75%. And then we may likely see another increase in the month of December. So the Fed is going to continue to be aggressive, and that's so they can fight inflation, try and bring that down, but they're essentially going to have to destroy demand in order to make that happen. So with demand dwindling, supply dwindling, we should still see price stability. However, with the Fed looking to aggressively increase the Fed funds rate going forward, it's likely that or not likely, but guaranteed that we're going to see all of our consumer products go up in cost. Your lines of credit, your auto loans, your credit cards, all of those are going to go up in cost as the Fed increases the Fed funds rate. Because remember, the Fed funds rate is short-term lending rates and not a direct impact on long-term lending like mortgage rates. So that is what we are focused on as we head forward the rest of this week and the rest of this month. Yeah, as always, if you have any questions about any of the information that we've covered today, hit me up on my phone right here. Feel free to leave comments down below. If you're watching this on the Powerhouse Facebook group, thank you so much for being an amazing part of our community. If you're checking us out on YouTube, make sure that you smash that subscribe button so that way you can get up-to-date real estate and economic data at your fingertips on your phone. All right. Well, again, I am Sean with the Sean Richard Mortgage Team. Thank you so much for tuning in to this episode of SRT Live, and have an incredible rest of your week.